Coach Jeff here today to talk about an important topic for real estate investors, and it's the topic of raising capital. Everybody's heard the old adage of you need money to make money in this business, and that's in any business. And it's very true if you are in the rehab side of the business. So I'm really speaking to those who want to buy a property and rehab it. Now, two ways to go. If you're buying it to rehab it to resell, that's one way. If you're buying it to rehab it to then refinance it after you've rented it and then repeat that BRRRR method where you want to buy it and put it into your rental fleet, that's a different thing. I'm primarily speaking to those who want to rehab into the retail market. In other words, you want to fix up a house so that it can be resold to an organic buyer, some first-time home buyer or not first-time home buyer. If you're in that market in particular that, will live in the house. And by the way, right now, there's some great programs out there the government is offering for first-time home buyers who have low to moderate income. So that's the market, first of all, that I'd focus on. I would focus on the first-time home buyer market in whatever part of the country you're in, because that's where all the buyers are going to be clawing out of the woodwork coming up soon, and they're going to have great rates available to them, low down payments. And the only thing they won't have is a lot of properties from which to choose to buy. So if you've done a nice job of rehabbing yours and you're in that price range, you'll get the pick of the litter in terms of a buyer. You probably get at or above asking price, and you could go back to those days of having multiple bidders. But the topic for today is how do you raise private money to get that accomplished? Well, there's a number of ways. First of all, it depends on your credit and your credit availability. If you've got an IRA or you've got the cash itself, you can either borrow against the IRA or use the cash if you've got the cash to do that. I typically would advise against doing that. I would say don't use your own money. Use private capital of some form or fashion. There are multiple ways to do that. You can go to a bank and get a loan. You can go to a private money lender and get a loan. You can go to a hard money lender and get a loan. You can borrow from family, friends, and you can cobble together the funds to get these kinds of things done. We're going to talk primarily about the raising of private money through non-family and friends, people you don't know. So the two main methods are private capital, hard money. They're essentially one and the same. There are some differences. Hard money are typically in this business specifically to loan money to investors that need the money for this particular purpose. Some of the aspects and features of hard money is they're typically quick and easy to get. They rely less on your credit score or not at all. They rely on the value of the house fixed up and as is. They will typically have lower advance rates. In other words, you may only be able to borrow 70% of the purchase and 80% of the rehab costs, or some combination. There's some 80/80s out there. There's some 80/100s, but you're not going to be able to ever borrow 100 cents of the dollar. And most of the time, from private lenders, that's the case. However, there's some where you're going to be able to borrow 100%. I'll talk about that in a second. The hard money guys will typically have a lot of points for whatever money you borrow. So it could be 4, 5, 6, 7 points. So in other words, a point, and for those of you who aren't familiar with it, a point is 1% of the money you borrow. So if you've got a loan that you're going to borrow $100,000 to purchase and another $100,000 to rehab, that's a $200,000 loan, and you're paying 5 points, that's $10,000 right up front that the hard money person is going to get. And they're going to have a lot of other, we call them garbage fees. They're going to have fees for an appraisal. They're going to have fees for draws. They're going to have fees to write up documents, their lawyers. There's a whole bunch of other crap that can make that total number come up to 6, 7, 8, 9, in some cases 10% of what you borrow. And they make their money by taking risks on risky deals, risky people who have done a lot of deals and risky transactions where there may be a lot of work to be done. The way they mitigate their risk is by charging these fees up front in large quantities and by doling out the money to you in draws. So typically a hard money lender will hold back all of the money and then give it to you on a draw basis. So if you divide the rehab of the house into 4 segments of time, after each segment is done, they'll send somebody out to inspect it, take pictures, etc. If they agree that that amount of work has been done, they will advance you the amount to pay, or they'll pay directly to your contractor that amount of money. Typically, you have to have some funds to pay the contractor and you get repaid, but in some cases, you can negotiate where they pay the contractor directly or they give it to you and you give it to the contractor. Hard money is quick and easy to get, and if your credit is not great, it's readily available, but it is the most expensive. Now, on the private money side, private money can be anything from maybe a higher end hard money lender, somebody who does bigger dollars. They work with your credit score in a lot of cases, although not always. They're more of a relationship type thing. Typically, the points for a private money lender could be 2 points, 3 points, sometimes up to 4. They don't have a lot of garbage fees. There's not a lot of things that they charge extra, and they will typically have higher advance rates. So it's not unusual to get 100% purchase and an 80% rehab, or vice versa, 80% of the purchase or 85% of the purchase, 100% of the rehab. They won't give you, just like the hard money guys, they won't give you all the money up front, but you'll get some of it up front. And typically it's a lower interest rate. The hard money interest rates tend to be 15% or more. Private money tends to be 12% on down, 12, 10, 12, that kind of thing. So it's cheaper, but it takes longer to get with a private money lender. But there are less hoops you have to drive through, run through, hop through, etc. And your credit personally has to be a lot better. So those are the two main sources. There, you can also use family and friends. You can borrow money from people you know, that type of thing. But the large volumes of capital available are hard money and private money. Those are the two you should focus on if you're in the business of rehabbing. Later on in a future video, we'll talk about building your own fund and how to raise large amounts of capital from lots of different people. That's a whole different beast. Right now, as a beginning investor, if you've done less than, say, 50 transactions, do either hard money or private money, and that's going to get your best deal, your best bang for the buck.